Hi, Larry Gaines, Power Cycle Trading. Well, when the markets are showing a lot of kind of confusion and uncertainty, like we're currently in this kind of market environment, you can see here is the NASDAQ 100. You know, it's down, it's up. You can see the S&P was down, now it's up a little bit today. You can see the Russell's down hard. You can see the Dow's up. So there are a lot of kind of conflicting signals here across the broad markets. So when there's a situation like that, one of the best ways to trade it to neutralize your risk is to trade it using pairs trades or spreads. So let's talk about that. So what pairs trading does, it matches a long position with a short position in a pair of correlated instruments. So it could be like two ETFs. So here's an example. So here's the Russell ETF and here's the QQQ for the NASDAQ 100 ETF. Now if you look at this chart, you'll see that the Russell here, we're getting sell signals. See how it's broken the moving averages, moving to the downside? And then if you look at QQQ, it's holding the moving averages and it's actually holding steady. So you've got this pair, you've got this ETF coming off hard while the QQQ is staying steady. So with the spread or pairs trades, you can make money, 5 different ways. You don't have to be just, short to make money going down. You can, be long short something and you get that correlated effect. So here's an example of how you can identify these and you're neutralized. So if the market was to crater overnight in one direction, you're offsetting some of that overnight systemic risk because you would be long in this trade QQQ and short the Russell 2000 IWM. So here's what a pairs trade looks like. So we're playing the spread between the Russell, the IWM, and QQQ, the ETF. So two ETFs that are correlated together. So this is based on 100 shares. So if you went short 100 shares of the Russell 2000 and you went long 100 shares of QQQ, this is that spread. So look at this. This is a 4-hour chart. So I've got my spread on this right here. So this is the spread difference between the Russell and QQQ. So you just take, like, for example, here, right today it's 140.31 minus 144.06, and your spread value currently is the Russell's $3.56 per share below QQQ, or on a 100 basis, that'd be $357 or $60 below QQQ on per 100. So what you're looking at is a sell signal. So here is our indicators. This is a momentum flow indicator, and I've got this set to a 4-hour chart. So my momentum shifted here on, this was, the date was right here. The date was, one second, this was the July the 5th, okay? So you can see here, cycle 1 is my momentum indicator, and here's a percent. This is a overbought, oversold indicator. So you can see here when it started coming down back below, being overbought on the spread, and it closed here, and then we had cycle 1 go negative. This was the entry right there. So if you had gotten into this trade where you would have sold short 100 shares of the Russell and bought 100 shares of QQQ at the same time, you would be into this trade at selling the Russell at $3.11 over QQQ, and now the Russell is $3.70 below. So that's a gain of, basically $3 above, plus now it's $3.70 below. So that would be a $670 per 100 share spread profit. So if you did 100 shares of this, selling short 100 Russell, buying 100 QQQ, you'd be up $600 and around $60 per 100 shares. And it's a neutral type trade because if something, systemic risk or something happened overnight, you've got a short to offset the long. And again, if you, I'll do another video here, but if you go through a spread, you can make money 5 different ways, versus if you're long, you can only make money if it goes up. If you're short, you can only make money if it goes down. Hope this helps. Talk to you on the next video up.